So in this video, we are going to help you understand that you do not need to capture glamorous, glorious, amazing moves every single day to become a consistently profitable trader. On the contrary, it's my goal to capture small base hits over and over, but learn to master them, right? So today in this video, I'm going to show you the tools I use and the philosophy I use, right? The mindset that helps me do this, right? So the day we're going to be talking about is October 23, 2024, right? And in front of you guys, you're going to see a chart, and you're going to see here, I took a short play here and captured a $10 move on SPX, which is a $1 move on SPY, right? And on this move, I made $540, and my ROI was 79.41%, right? So an 80% ROI to make $540 off a $700 contract, right? So just to put that in perspective, I bought one contract for $700. I risked $200 of it to make 80% ROI, to make $540, right? So my risk reward is completely in check. I'm risking 200 to make 500, right? That is my goal every single day. It is not my goal to capture the whole move, right? If that happens, so be it, right? And I'm going to show you a very simple way to do that, right? Because our approach, which is very repeatable, is highly effective. So I'm going to show you the criteria I use, the way I trade it, what I look for, so that I can capture moves like this each and every single day, right? So if you're new to my channel, right, I trade the pit numbers, right? What are the pit numbers? Pit numbers have changed my life. Pit numbers have been a massive epitome that has helped me become a phenomenal trader. And it is my goal to help you understand what they are, right? Because if you could understand what they are and how they work, you'll become a way better day trader. Trust me, right? So the pit numbers are the previous day high, previous day low, previous day open, and end of day, right? So we use these four main levels to identify higher probability setups in the market, right? These levels, why are they important, right? Well, it's very, very simple, but to understand it, I have to bring you back real quick. So these pit numbers are important because it is our job not to predict price. It is our job to react to the people who control price. This is the banks, the institutions, the people with large amounts of capital. It really doesn't matter who's controlling price. All you need to know is you are not controlling price. You can't control price, you can't manipulate price, you don't have the capital, you don't have the influence, right? So you must understand that for you to make good decisions. Otherwise, you're going to constantly try to predict what's going to happen. This is what I used to do. This is what used to lead me to horrible months and just super inconsistent results, right? Because I had no process. I had no understanding of the game I was playing. Don't do what I did, right? So identifying the pit numbers, the areas that hold massive amounts of liquidity, are going to keep you focused on the levels that actually matter, right? So we have previous day low, we have previous day high, we have end of day, we have open print, right? What's really funny here is you'll realize open print is actually extremely close to the previous day open print, right? Why do you think that is? Well, I'll tell you, it's not a coincidence. It's because there's massive volume there. So if sellers want to take control, that would be a great place to do it. It's that simple. There's nothing else to know, right? So we have open print established. We have everything established. So when I'm watching this market, what I'm doing is going, okay, there's two things that can happen here, right? And obviously there's 2 billion things that can happen. But based on what happens most often, there's two main scenarios. See, the sooner you can become a trader that thinks in a probabilistic fashion, meaning what has the highest probability of happening, the sooner you're going to become a way better trader that's way less stressed out. I used to stress all day about, oh, what if this happens? Oh, what if this happens? Guys, you got to stop doing that. Become a trader and wrap it up. There's two main things that can happen today. Buyers are going to take control of open print and price is going to go up to end of day. Or sellers are going to take control of open print and price is going to break down to PDL and our bearish target, right? It's that simple, right? Stay concise. Stay focused on what has the most probability of happening. And I can speak this way, right, with this conviction on these two scenarios because I have logged over 4 years of trading data and I've realized the market imbalance, which is the space in between open print to end of day, open print to PDL, PDL to bearish target, right? That's what we call a market imbalance, right? This right here would be a market imbalance. right? That's a market imbalance. This is a market imbalance, right? So price gravitating from critical level to critical level, that's a market balance, right? So the reason I can say that confidently is because I've back tested and logged and analyzed 4 years of trading data and realized there's an 88% chance that the market is going to gravitate from critical level to critical level, which leads me to my 50-50 perspective that if buyers hold open print, I'm targeting end of day. If sellers hold open print, I'm targeting PDL. And if sellers hold PDL, I'm targeting my downside target, right? So now that we have that understood, right? That's the critical level. That's the pint number. That's where they're derived from. That's how I trade them, right? It leads us to our next criteria, which is moving averages. Now, for me to dive deep into moving averages, you have to understand why I love them and believe in them so much, right? So let's bring it back to the early years day trader, right? Josh, as an early day trader, beginner, used to always try to capture reversals, right? Now, think about it. Reversals make sense, right? Buyers show up here. Why wouldn't they show up here, right? Well, yeah, that sounds good and simple. But the thing is what happens when you go long right here, right? Say you captured a long off PDL to open print. That's a great trade. But what happens when price comes back into open print here, or PDL, and sellers push through, right? You're lacking a tool, which I call your ability to identify acceptance, right? See, when you're trading against trend, you are trading in a lower probability fashion, right? Because if the trend is down, that means there's a higher chance of it continuing, right? So you want to be very careful while trading reversals. Do me a favor, go through your journal, look at all your losing trades. How many of those losing trades were reversals? For me, it was over 80%. There was 1 month where I logged, I think it was like 27 trades. Out of those 27 trades, 18 of them were losers. Out of those 18 losers, 14 of them were from trying to capture reversals. I remember the month like it was yesterday, right? It was a horrible month for me, but it was such a good month because it was the month that I realized I needed to stop trading reversals. And see, this is why so many traders fail. It's not because they're bad traders. It's not because they don't know what they're doing. It's because they're not self-analytical enough. They're not able, right, due to laziness, due to incompetence, right, due to arrogance, right? They don't go through their losing trades and they don't collect all the data and they don't analyze it. See, if you went through your losing trades and analyzed it and said, hey, man, every time I'm taking an L, I'm trying to capture a reversal or whatever it may be, you would be a way better trader, right? So if you take anything from this video, let it be that. Go through your losing trades, identify where it is you're failing, and change it. So that's what I did. So once again, step number 1, critical levels. Step number 2 is your moving averages. You got to use your moving averages, right? In this scenario, we're below the 50 EMA, right? The cloud is red, right? These are bearish indications, which means I want to trade with sellers until buyers take open print. If buyers came up here, took the 50 back, and got above open print, then I would be bullish. Until then, I'm bearish, right? So then price comes into previous day low, where we capture our first trade of the day. We come into PDL. So number 3 is our entry criteria, right? And that is going to be our RBI, our GBI, right? Well, what does that mean? Well, it's an acronym for green bar ignored, right? So price comes into PDL and we get a green bar, right? Now, it's super important that you do this at the critical level. Don't just pick a random spot in a chart and go, oh, that green bar's been ignored, I'm short. No, go, hey, listen, we're at the critical level where all the volume is. So if a green bar can get ignored at this level, now you have a higher probability setup. And what you're doing here is you're not predicting, you're reacting to what the market's giving you, making it a very high probability setup, keeping you from assuming that this is going to happen or breaking into that tunnel vision, right? That keeps you so focused on what you want to happen. See, instead of that, you're looking at the market and you're going, okay, right? We're in a bearish, market's bearish, right? The conditions are bearish. We're at previous day low. I'm getting a green bar, ignore it here. I'm going to go short and put my stop above it. And doing this is going to keep you in a phenomenal higher probability setup with extremely low risk, right? So price kicks off, sells off PDL, phenomenal trade, right? Now let's look at the trade that was literally only $10 and was an 80% ROI, right? So this trade happened here. Let's see. Let's whip out the Discord so I can get the exact entries and exits here. Okay, let's see here. Okay, October 23rd, 2024. In short, stop above 579.20, right? So this was at 12:11 p.m. So that's me on the Discord referencing the SPY chart, right? But I'm going to show you on SPX. They're literally the same. So at 11:20, right, which is this candle right here, the market looks just like this, right? We're still very bearish. We sold off below PDL. The 1 hour time frame looks really nice, right? It's holding trend. So now, once again, I'm not looking for a spot to go long, right? I'm going, hey, I have a bearish target all the way down here. There's an 88% chance that the market imbalance is going to happen, right? This is the market imbalance, critical level to critical level. So why wouldn't I go short? All the data tells me identify short criteria here and get in the market, right? Don't assume it's going to reverse back up to PDL. Don't assume oh, man, I missed the whole move, so now I got to go long because I missed the shorts. No, the market's selling off. It's bleeding. You want to get into the market short. Listen to what the market's telling you, right? This is how the market communicates. The trend is bearish. Trade with it, right? You just need to identify your criteria, right? So in this scenario, we have low of day, right? We have price coming into low of day. So it's up to us to identify selling acceptance, right? So price comes into low of day. All the moving averages are holding. So now I need to identify my higher probability setup, right? My entry criteria. And that's going to be our green bar that gets ignored, right? This is our green bar right here at 12:20, right? And then the next candle, boom, blows through it. So I got in the market on this candle here when price shattered through the green bar. My stop loss is above it. So guys, just to be very clear here, this is what the market looked like when I was getting in short, right? The market was selling off extensively, right? Sellers were clearly in control. Why do I know this? Because they held open print. They held previous day low. My 1 hour time frame had a healthy trend in it, right? We weren't extended from any moving averages. Instead, this is exactly what I need to see to put on a short play. Went short, my stop was above it. We caught a beautiful move all the way down. You can see me here in short, stop at my entry, right? I like to really be very clear on the Discord so everyone can see it. This is the 5-minute trend, right? Notice here, we're selling off. The EMA cloud is holding very well. It's red, right? We're holding the moving averages. We're targeting downside targets, right? Guys, I want to be very clear here, right? Follow the trend. Look at here. 9D EMA is blue. We are not extended from it. Price is hugging it, right? This is a very high probability setup. See, we sell off all the way here into target. Out. I'm out at 12:32 p.m., right? Which is this candle right here. Bam. So guys, I hope you learned a lot from this lesson. There was a lot of information. Hopefully you took notes and retained some of it, right? But real quick, just to go over what we learned here, we trade critical levels, right? We trade with moving averages, right? We trade with high precision entry criteria with very low risk. Guys, if you want to get involved, click the links below. I have a phenomenal platform, Trader Bootcamp, where you can learn all this information, right? And become a super confident trader. I'll see you in the next lesson.